All right, welcome back. Today we're going to have a fun session introduction. We're going to talk about one of our favorite parts in the actual real estate business, closing day. Not only because that's when disbursement happens and hopefully we've earned our very hard-earned paychecks, but also because, in my opinion, not all of us earn awards in our business, but to me a closing is the award that you get every time you complete a successful transaction. At the closing table, depending on how it works in your jurisdiction, usually you've got a buyer, a seller, you've got both real estate agents, your settlement agent, and there's different nuances for how different states work, but that's usually the culmination of a successful transaction. Hopefully your seller's happy, your buyer's happy, and the closing is the final settlement of the transaction, the completion of the transfer of this property from seller to buyer. And in most cases, it's a really happy experience, and I feel like every time I sit down at a closing table, it's just a well-earned reward for all of the work that goes into all of the marketing, the attracting of the clients, all the paperwork, everything that has to be done to get to the closing table. So today we're going to learn about some of the things that happen at closing. So, well, of course, your chapter topic is closings. You're going to hear it referred to as settlement, and again, this is another one of those sections that different states, different jurisdictions have varying policies and varying methods of that settlement day or closing day. Sometimes there's attorneys used, sometimes you have an escrow agent, some closings can even take place at the brokerage office or even at the lender's office. So it really depends on how things work in your jurisdiction. So there's some information in your state-specific content, or of course later when you get a license, you should have a broker or mentor that can really help you to know exactly how things function for your area. But there are some policies and some procedures in that closing process that are going to remain the same wherever you're at. So let's take a look at some of those. So first off, one of the things that happens in the closing preparation process is preparing that title to transfer. Remember, we've talked about deeds, we've talked about title, that concept of ownership. So closing is usually when that title, the deed, is signed over and the ownership of the property transfers from one person to another. There's several terms surrounding that process, and I want to take a minute just to clarify those first. So throughout the chapters, you've heard title, you've heard chain of title, you've heard title abstract, opinion of title. Let's clear up the differences because it's surely important to know. Now remember, the deed is the actual document. The deed is the document that makes that transfer happen. Title is the concept of ownership. So imagine, like in my state, Georgia, we have to prove 50 years of title, 50-year history of ownership before we can complete the transaction. Because if you sit down at the settlement table and you're purchasing a house from somebody, how do you know for sure that that owner across the table from you is the legal, rightful, sole owner of the property and even has legal authority to transfer it to you? It's very important. So in most jurisdictions, a closing attorney or a title agent is the one with an authority to go into the courthouse records and make sure that the owner selling to you is the legitimate owner. Like I said, in Georgia, we have to go back 50 years of research every time there is a title transfer. So if title is a concept of ownership, and I said that we have to prove the chain of title, that's also a concept. So I like to imagine, remember in elementary school, you'd make those paper chains to decorate the Christmas tree. Oh, your mom loved them, didn't she? But you'd make the paper chains so one loop connects to the other, that loop connects to the next, and you make a little paper chain. Imagine that as an ownership record. A purchaser buys a property, and then the purchaser sells that property to another purchaser. Remember the grantor, grantee? So grantor sells to grantee. But what happens next? Now that previous grantee becomes a grantor and sells to the next grantee. Does that make sense? Grantor to grantee, grantee becomes a grantor in the next transaction, and that's how that chain of title is created. But what happens if there's a break in the chain? For whatever reason, maybe there was a forged document, maybe a death happened at some point and the will wasn't probated properly to put that deed into someone's name that had the authority to transfer. What if there was even something simple like a name change? When I married recently, I had to change the name on my property. So I bought that property as Marlene Lane, I sold it as Marlene Douglas. Something like that, and the record not clarified, could have caused what they called a cloud on the title, like a big black cloud that follows the ownership record of that property. There's something wrong that could interfere with the current owner's ability to transfer it to the new owner. So title is the concept. Chain of title is just knowing that throughout the history of that property, it's transferred from owner to owner. Now remember, we said that the settlement agent sends an abstractor, a title researcher, to the courthouse to actually look at the records. Well, once that abstractor looks at the records and writes down grantor, grantee, grantor, grantee, makes a list of all those names, he now turns in to the settlement agent what's called an abstract of title. So chain of title is the concept, just knowing all those owners exist. An abstract of title or title abstract is where you take all of that information, write it down. Now it has to be certified by somebody. So once it is turned over into our escrow agent, closing agent, depending on your jurisdiction, that is certified, and usually an opinion of title is written where they've looked at all the names, they make sure there's no cloud, and they're certifying to say, yes, it looks like our current seller is the legal owner of record and have clear, unmistakable ability to transfer to a new owner. So it's a very important concept. I can guarantee you can see that again, and want to make sure you know how all those terms work together, because it can be a little bit confusing. So let's advance forward a little bit to the actual settlement process. Real Estate Settlement Procedures Act, RESPA, R-E-S-P-A, very important. You're going to get into some really big details in this chapter about all of the different things that are controlled by the Real Estate Settlement Procedures Act. The government enforces that nationwide to make sure that no matter what the states require, each jurisdiction requires, that buyers are protected in the settlement of the properties, and to make it a fairly uniform process. So we're transferring title from buyer or from seller to buyer. Think about that for a second. Think about things like the payments that have to be made. The previous owner maybe has paid a power bill. The previous owner has tax liability for the taxes for the year. What do we do to make sure that as of the day of closing, the seller is responsible or has paid all of their owed amounts, and the buyer now picks up and is responsible for any future amounts? Things like the taxes, the annual property taxes that are usually just paid once a year. Well, who's going to own the mailbox when the tax bill comes in? That person is responsible for the entire year. But if the buyer buys the house in, say, November, he doesn't want to pay the taxes for an additional 9 months that he didn't own the house, right? Well, of course. So there's going to be some disbursements, and we call those prorations, that the buyer and seller both can be responsible for their pro rata share of any of those expenses. So let's clear that up a little bit. You're going to have an example in your book that lays out the actual settlement process, but before you get there, let me show you a couple things. I want you to imagine that these are two completely different transactions. You have buyer cost, you have seller cost, and if I was teaching this in class, you'll see it in your book as one big piece of paper with a line item down the middle with a list of different expenses. In class, I like to fold this in half. So for a second, ignore this side. Let's think about just the seller. I want you to imagine this like you would imagine your checkbook register. Every time you make a deposit into your checkbook, you write down that dollar amount. When you pay the bills, you subtract that. So when I deposit money, that's a credit to my account. When I pay a bill back out of that money, that's a debit to my account. The settlement agent is responsible for an accounting of all of the money in the transaction. Goes into the bucket, it's your settlement agent. All of the money, including real estate commissions, are dispersed by that settlement agent, and at the end of the transaction, there should be a zero balance in that bank account, if you will. So I want you to remember, because it can get confusing, that like I said, there's two different sides of the transaction. So think about this. The buyer is buying the house for $200,000. Where is that money going to come from? The money's going to come from most likely a lender, or it could come from cash in the buyer. But for a second, let's pretend it's a lender. So he would actually get a credit of the $200,000 from the buyer, and then he would also be paying that same $200,000 to the seller. And if you can imagine, like I said, both sides have their own separate accounting. But who's responsible for what? Your book talks a lot about debit to the seller, credit to the buyer, and people always think that everything has to be on both sides and both parts of the transaction. But think about this. There are some fees only charged to one party. There are some things that are only received by one party. So whenever you're processing all of these different prorations, keep in mind that the buyer and seller both have their own accounts, and it'll help you to learn the different prorations of taxes and interest and different things if you think about it that way. That the seller has his own bank account, if you will, in that transaction. The money comes in, money goes out for everything he's responsible for, and then the buyer also has their separate side. Sometimes the money comes from the seller to the buyer, sometimes it comes from an outside source, but just remember that there's two different sides of the transaction. So the next thing that I want to discuss, if we're talking about prorations, sometimes we have to look at the number of days to do a proration. So say we are closing on a house on the 15th. Not only are we looking at how many months somebody might owe, but most of your prorations you have to calculate by the number of days. So say the tax bill covers 365 days. We'll have to divide the year apart to see how many of those 365 days are the seller's responsibility and how many of those 365 days are the buyer's responsibility, to make sure that on the closing date everybody pays their proportionate share. So for taxes, we usually say that for the day of closing, the seller is responsible. Because if there's one bill, typically the seller is responsible for any cost of ownership. So next though, you're going to be prorating insurance. Because again, we don't want to pay for the whole year if we're not going to be in the house for the whole year. Who do you think would be responsible for insurance the day of closing? It's a trick question. Remember, there's a buyer side and a seller side. Most likely, the buyer and the seller are going to have their own insurance policies. So don't let it confuse you when you get into the material and there's two different ways to calculate insurance. Because remember, the seller's got his own policy that he may get a credit back for. The buyer is going to be starting his own policy on the day of closing. What about interest? The same thing. If both parties have, and if the seller has an existing loan and the buyer is getting a new loan, you'll be calculating an interest adjustment for the buyer and also interest accrual for the seller. Remember, two separate concepts. And then also remember, we've talked about investment properties. What if you're selling a property where a tenant is already in that property? They've paid rent to the seller on the 1st, we're closing on the 10th. Does the seller get to keep the money for the entire month? No, he's actually going to give to the buyer a portion of that rent for the time that the buyer would own it. And it's only fair that if the seller is responsible for the expenses the day of closing, remember there's only one rent payment, not two separate accounts, the seller would keep the credit for rent the day of closing, and you'll calculate your proration of the buyer's share from the day after closing until the day that the next rent payment's due. So So hopefully that'll help you to break apart some of that math. You're going to get into some math concepts, all dealing with prorations of the amounts of closing day settlement, and also deeper into some of the laws and regulations surrounding that settlement process to make sure that everything is fair, and also to make sure that everyone has designated recognizable forms and formats that are required by law for the buyer and seller to receive, to know exactly what that process of settlement is going to look like. So enjoy this chapter as you take your first pretty good dive into some math in this section, and we'll see you soon.